Most people don't think 10 years makes a big difference. 10 years feels like plenty of time. 10 years feels flexible, something you can always make up for later. But when it comes to investing, 10 years is not just time, it is leverage. And starting 10 years later can quietly cost you more than most people realize. Today we're going to compare two people. Nothing dramatic, no extreme examples. Just two ordinary individuals making ordinary decisions. One starts investing at 25. The other waits and starts at 35. Same investment, same returns, same discipline. The only difference is when they begin. Let's call them Investor A and Investor B. Investor A starts at the age of 25. They invest 10,000 rupees every month. They do this consistently. No skipping, no stopping. They continue for 30 years until the age of 55. Investor B does not start at 25. They wait. They focus on career. They focus on expenses. They tell themselves they'll start once things feel more comfortable. At 35, Investor B finally begins. They also invest 10,000 rupees every month. Same amount, same funds, same returns. They also invest until the age of 55, and so let's pause here and look carefully. Both investors invest the same monthly amount. Both invest for the same end age. Both earn the same returns. The only difference is that Investor A started 10 years earlier. Now let's look at the math. 10,000 rupees a month is 1,20,000 rupees a year. Investor A invests for 30 years. That means Investor A invests a total of 36 lakh rupees. Investor B invests for 20 years. That means Investor B invests a total of 24 lakh rupees. Already you can see a difference. Investor A invests 12 lakh rupees more. But here's where most people misunderstand the real cost of waiting. The biggest difference is not how much they invest, it's how long their money stays invested. Let's assume a realistic annual return of 12%. Not aggressive, not optimistic, just a long-term average. Now watch what happens. Investor A, who started at 25, ends up with roughly 3.5 to 4 crore rupees by the age of 55. Investor B, who waited until 35, ends up with around 1.5 to 2 crore rupees. Same monthly investment, same return, a difference of more than 1 crore rupees. Let that sink in. Investor B did not make a bad decision, they simply made a late one. This is the real cost of waiting, and this is where visuals make this painfully clear. If you plot both investors on a graph, the early years look almost identical. The lines stay close. The growth feels slow. This is why waiting feels harmless. Nothing dramatic seems to happen at the beginning. But as time passes, the gap widens. And then suddenly, it explodes. The money invested at 25 has decades to compound. The money invested at 35 is always playing catch-up. Compounding rewards time far more than effort. Now here's the most surprising part. Investor A stops investing at 55. But their money does not stop growing. Even if they never add another rupee, the compounding engine is already built. Investor B, on the other hand, has far less momentum. They need more effort, more years, or more risk to reach the same outcome. This is why starting early feels unfair. Not because early investors are smarter, but because time does the heavy lifting for them. Now let's address the most common reaction to this comparison. Many people watching this are not 25. They're closer to 35 or even older. And this is where the wrong conclusion often happens. People see this math and feel discouraged. They think they're already late. They think they've already failed, but that is not the lesson here. The lesson is not about regret, it's about awareness, because the same comparison applies today versus 5 years from now. Waiting 5 more years will still cost you. Waiting 2 more years will still cost you. The cost of waiting never disappears, it only increases. The second mistake people make is assuming they can catch up later. They tell themselves they'll invest more in the future, they'll take higher risks, they'll make aggressive moves to compensate, but higher returns are not guaranteed. Higher risk increases stress, and aggressive strategies often fail under pressure. Time, on the other hand, never demands effort. It only demands patience. This is why early investing looks boring, and late investing feels stressful. One grows quietly, the other constantly feels behind. Now here's the most important takeaway from this entire comparison. The goal is not to beat Investor A. The goal is to stop becoming Investor B in the future. If you are investing today, you are already ahead of the person you would have been if you waited another 5 years. That alone matters. Starting now does not erase the past, but it protects your future. This is why the best time to start investing was 10 years ago, and the second best time is today. Not next year, not after the next raise, not when things feel perfect. Because perfect conditions never arrive. Time keeps moving forward regardless, and your money either compounds with it or it doesn't. This is the quiet truth about investing. The biggest losses don't come from market crashes. They come from waiting, from delay, from hesitation, from underestimating time. And this is why starting early changes everything. Even when the amount feels small, even when the progress feels slow. This is the Wealth Blueprint, and in the next video I'll show you why most people still fail to build wealth even after starting early. Subscribe if you want clarity, not hype.